Hello everyone, this is Alexander Nikolov from trendrecognition.com. In today's video I'm going to use the current example of the current forex market in the Euro USD rate, actually the Euro dollar market, to discuss with you the topic of how I put protective stops on my positions. This is the daily chart of Euro dollar. And a week ago, I was looking at this chart without this decline, the decline from last week, and the chart was looking bullish to me. Why? Because the price pattern was kind of a choppy sideways, but the prices were trading near the upper line, near the upper limit of the broad sideways consolidation range that was intact for quite some time. And I thought that a break above the 145.30 level, this is a previous swing high, would result in a sharp move higher. So I placed an entry point at 154.30 to 40 level to enter long if a breakout occurred. And what happened? The market broke higher, but only marginally, with 5 to 10 points, and then collapsed sharply. How can one approach this situation? Well, first of all, if you have a tight range consolidation and you expect a breakout, it is worth to try to catch the next big move. So entering long on a breakout on the upside, or taking a short position on a breakdown, is something that is worth considering. And actually, that's something that I don't want to miss out. So going long here was a right choice for me. But then one should protect themselves in case the market moves in the opposite direction. If you play on a breakout, it's important to have a protective stop between 50 to 100 points, depending on your time horizon. But actually, you may increase your stop to even to 200 points after the market rallies a bit and then declines, in case it can go a bit further on the downside, retracing its gains. But at the time of the breakout, it's important that the market simply breaks and does not return back. So a 50 point, 60 point stop is something that should be used in this situation. So what happened? Let's go to the hourly chart. Here's what happened. The market broke higher above 145.30, 40 level, but then spent sideways below that level and then collapsed. During this collapse, I got stopped out here from my long position, and I was neutral. Then when I saw the sharp decline was followed by a simple corrective pattern that was clearly overlapping move, a clear corrective move, retracing less than 50% of the previous decline, I thought that probably that was a good indication that the trend was already down. So here I initiated a short position. Why? Because we had a failed breakout, and usually from a failed breakout, a fast move follows on the opposite direction. And that's exactly what happened. As you know, the market collapsed. The Euro-US dollar market declined sharply on Thursday and Friday last week. Actually, Euro dollar declined more than 250 points for these 2 days. And how I can approach the market? If you short here, you can initially place your stop above a previous chart level. In this case, this would be notice this prior resistance, then acting as support. So as if you short the market here near 144.20, 144.30, you can place your stop above 144.85 level. And as the move down confirms and accelerates, of course you can add further shorts on a confirmation. That's just a matter of style. But then you can lower your stop to the 21-hour moving average if you're a very short-term trader. And that's exactly what I did. One can so my approach is to lower the stop to just above the 21-hour moving average in this case, and above a previous swing high. That means that after this decline here, my stop went here too. Then my stop after this decline, my stop went here above 143.80 level. Then after this decline here and this consolidation here and this decline, my stop went here at 142.90 level. Usually it's better to place your stop 5 or 10 points above these key levels. And notice that even the volatility at the employment report, which brought huge volatility, euro initially rallied, then resumed its decline. This volatility did not stop out the short position if you used this method. So my method is simply lowering the stop to just above the declining 21 moving average, and place it a few ticks above the previous important chart support or resistance level. The opposite is of course true in an uptrend. If you are long, you can move your stop to just below the rising 21-day or 21-hour moving average, depending on your time horizon. And do not place, of course, the stop right on the moving average, because sometimes it is touched, but the trend continues. So also use a previous chart level that was important, was a level that acted as resistance or support, and place your stop above or below that level. So that's my approach. I currently still hold this short position with a stop above this level, above 142.90, and I expect lower prices. As for a target, if you expect a limited limiting move on the downside or on the upside, you can use a predefined target using some Fibonacci techniques. But in case you expect you allow for a larger downside potential, like the current trade, as you know, this failed breakout here produced this sharp move lower, and a case can be made that you had a decline followed by a sideways consolidation and then another decline to 137, 135 area. So there is a potential for a huge move down. In this, under such conditions, I do not want to have a position that is exited too early. So I prefer to simply lower my stop, and if stopped out, to look to re-enter on the short side on a rebound, but to try to hold and to stay with the trend as long as I can. So I hope this helps. I used this current example from the euro-US dollar market to indicate, to show you actually my trading strategy using the 21 period moving average as a trailing stop. And see you soon later.